Really excited to have this chat with everyone. We're very keen to share with you the report and the findings, and I hope you've had a chance to already download that. So very welcome from wherever you're logging in, and really excited to have this conversation. We have our lovely panelists already in the room. I know Zachary is on his way, so he'll definitely be plugging in when he can. So let's start by introducing me. My name is Namara. I'm a senior venture partner at the Baobab network. Essentially, my role entails three key things, which is identifying great founders, venture building and investor relations. And so really excited to have the pleasure of hosting this panel and speaking to and having you all in here. So we are here to talk about the report that we recently put together in conjunction with Techable Insights and Future Africa and the Baobab Network. And this is basically us asking ourselves the questions around whether investors are making bets on early stage startups on the continent. What does that look like? What do the trends tell us? Is this going up or down? And so we're super excited to share that with you. So for those of you who are not familiar, Techable Insights is an Africa-focused digital economy consultancy that leverages big data to help startups, investors, operators, big tech companies, governments, and other ecosystem players on and off the continent to answer specific questions and implement key interventions. Future Africa, I'm sure you're familiar with, is a fund manager that invests early in mission-driven founders solving hard problems for large markets. Their mission is to build an African future, by turning our most difficult challenges into global business opportunities. And finally, the Baobab Network, which is the third partner on the report, is an accelerator for early stage technology companies in Africa. In the last 3 years, investing in 25 startups in 11 African markets. And essentially our role is to do two key things, which is build a thriving ecosystem for early stage tech startups, but also build really good pipeline for investors further down the line. We do most of our work through our research work through the Baobab Insights, which is our market intelligence arm, and we leverage ecosystem data every day to make these decisions. So today we have two really excellent people on our panel, and I'd love to introduce them to you. So let's start with Yvonne Johnson. Hey Yvonne, are you on?
Yes, I am. Hello, and great to be here. Thank you for having me.
Thank you. Absolutely. Thank you for joining us. I hope that I do your intro justice. But Yvonne is the co-founder, CEO of Indicina, a fintech infrastructure startup. She's a strategic thinker with a demonstrated ability to influence change by leveraging innovative solutions. She comes with over a decade of leadership experience supporting executive management and strategy within financial services. Most recently, Yvonne led the strategy team for Tier 1 Nigerian banking group. She received her MBA at the Kellogg School of Management. Notably, she led the effort in defining a digital financial strategy for the bank, including the launch of its first ever innovation hub. An honors graduate of the University of Toronto. She's all-round excellent, an early stage investor, advisor in Pan-African technology startups, notably Andela and so we're really honored to have her here and having this conversation with her. We also have Zachariah George, who mentioned that he's in transit, but I will still do the intro, Zachariah. And hopefully you can still have the chat till you're situated.
I'm actually very much here. I'm just driving and I'm fully accessible. Okay. So yeah, please.
Lovely.
I can
okay.
Absolutely.
All right, great. Thank you so much for joining us. It's lovely to have you, and similar to Yvonne, I hope I do your introduction justice. So Zachariah George is a managing partner at Launch Africa Ventures, a prominent and active early stage venture capitalist fund across the African continent. He's also co-founder and chief investment officer at Startup Bootcamp Afritech. Zach is widely recognized as Africa's most prominent angel investor, with investments in 100 plus of the leading tech startups in Africa, including Flutterwave, Kuda Bank, Mpost, and I mean, the list goes on. Zach has a master's degree in finance and management from Stanford University. 3 lovely kids, and we're really excited to have you here. Thanks for joining us.
Most welcome, most welcome.
All right, before we crack on with the conversation, I'd just love to mention to everyone in the room that there's a chat room, and so we're happy for you to introduce yourselves in there. Please add your LinkedIn, let's meet each other. And secondly, if you have any questions, also put them on there. We will have someone moderating the chat rooms, and then we will get to those questions towards the end of our conversation with the panel. Yay, okay, so let's get cracking. I'll start with you, Yvonne. Early stage startups are mostly pre-revenue and some even pre-product. What do you then look for at the early stage? How do you evaluate the startup with and their prospective growth?
Thanks again, and thanks again for having me. Really excited to be here. I mean, just like you said, you know, at that early stage, there's not a lot of hard metrics to work with. You know, sometimes pre-revenue, sometimes even pre-product. So what you do have to work with is really where you kind of place your bets, right? It's things around the team. And, you know, I know we say that a lot of times, but when you think about the team, you really dig into their background, right? You know, their domain knowledge, their expertise. You know, the question you're really trying to answer in your mind is that, you know, is this a team that can, you know, build this thing and, you know, generate an outsized outcome, which is really what kind of venture capital is about, right? You know, so the team is a big checkbox in early stage ventures, right? Just like you said, when there is kind of little to work with. I think there's other things you also look at, and I think that's just kind of general investing 101, things around the problem, the viability of the solution, how big the market is. Again, just basic, you know, investment stuff. But really, for early stage, you know, you're looking at the team, what they've done before, and can they convince you that they can pull this off and generate an outsized outcome?
Yeah, absolutely. That we like to tell our founders, they are a big that them as a team are a big decision-making point as we're looking to invest, and that continues to be true. Thanks for that. Zachariah, even after funding an early stage startup, it takes some time before they begin to gain traction. So in these times, what do you measure in terms of performance? Like, what's good? What are you looking for at this point?
Yeah, I mean, first of all, I'd say that, you know, Yvonne's comment about team is super important. I want to maybe just stress on the addition to that, especially for teams that are pre-revenue but post-product. I think the ability of a founder, can you guys hear me? Yeah.
Yes, we can hear you.
The ability of a founder to be coachable and mentorable is extremely important and often quite a bit understated. So everyone talks about how, you know, how if someone is a repeat founder or a serial entrepreneur, they've got a much better chance of being funded. While that is statistically true, what really matters is the moment you take money from a VC or an investment syndicate, you're essentially allowing someone else to sit on your board and play an active role in the future of your company's operation. There are a lot of founders who still think to this day that they are the company, right? And that is usually the start of the end of a company. If you look at some of the biggest company failures from a tech startup perspective globally, it's Travis Cooper or Andy Neiman from WeWork. Those are just, or I mean, can you get, what's that, sorry? Did I cut out?
No, you had, yeah, for a few seconds there, but you're back on.
So I was just going to say, so it's very important early on when you talk to founders that you find this fine line between a founder being assertive and ambitious and them being arrogant, because that is a very, very slippery slope, right? So you look for founders that are mentorable and coachable, but at the same time, you don't want a founder that's too weak or too shy and coy, because ultimately the founder is the biggest spokesman for the company. So you need a founder that's charismatic, that can tell a story and gets people around him or her to believe in the true vision of the company. So, I mean, these are non-financial, non-quantifiable metrics, but at the early stage, at the seed and pre-seed stage, these are often the biggest factors that investors factor in. And then if you look at companies that typically go through accelerators like, Flutterway, like Founders Factory or Startup Bootcamp or Y Combinator, most companies that get in are either pre-revenue or just have a little bit of pilot revenue. So what we as a fund look for is what is the path to monetization that a founder and his or her team has. So especially when you work with large insurance companies, banks, retailers, and telcos, how are you able to successfully implement POCs, proof of concepts, or pilots, even if you're doing it at cost? So what I've always said is smart founders are able to sacrifice margin for volume. What that essentially means is, are you willing to share revenue, look at licensing agreements, look at JVs, and reduce the margin you make in exchange for getting more people to work with you? I think that is a key indicator of the willingness of a company to exchange margin in scale.
Okay. Is that the key things that you're looking for post-investment in terms of measuring performance? Is those decisions that they make?
I mean, if you're looking post-investment, what we look at monitoring, there are a lot of things we look at. I mean, I was thinking more about how you would help a company get from sort of post-product pre-revenue, but post-investments are a whole bunch of things. I mean, like it's regular monthly reports on revenue, number of clients, employees, key contracts. We expect our portfolio companies to send us reports at a bare minimum once a quarter, but
monthly.
But monthly is sort of an industry standard now, especially at the early stage, right?
Absolutely.
We don't expect companies to send us massive reports, but a simple one pager on, what are your challenges? What are your biggest successes? What clients do you have in the pipeline? Basic figures like revenue and margins, etc. Key hires, and then key needs.
Absolutely.
And how can we help as an investor? Even if it's just a couple of paragraphs, that is an absolute plus.
Absolutely. Yeah, I completely agree with that. And like you said, it's typically just the little things that you're looking for, especially as they're growing early on. And you mentioned most of them, which is a sort of revenue, number of customers. And I think a big one is just how they're making decisions, which you can see from their reporting. Great, thanks for that. So let's go to the next question. So one of the most interesting things we found as we were sort of putting this report together is that the check at the seed stage the size of the check at seed stage has grown significantly. So companies like Float raising $17 million and Edukoya raising $3.5 million pre-seed. So this is an interesting trend, and I don't know, what do you think about this? Is it that early stage African companies need more money earlier on, or sort of what is this trend telling us? Yvonne, maybe you could share your thoughts here.
It's definitely an interesting one, and I think definitely saw a little bit of that towards last year, and I think for me and just kind of my angel investment group, we just kind of at the end of the day, you just kind of conclude that maybe it's a sign of the times and whatnot. But I think generally, with things like this, it's what I think is that there's probably a fluidity in the terms. I think historically, when you talk about kind of pre-seed, angel round, seed, now there's seed extension, pre-series A, and all these kind of things. My conclusion is that a lot of these terms are just really becoming fluid, because if you're in a market where you can raise a little bit more for different reasons, right? Maybe kind of the size of your idea, maybe just macro environment. There's a lot more capital out there. You can have people that are saying that, look, I would be opportunistic and take an extra 500K, $1 million, right? Now technically that puts me outside of the bounds of pre-seed or angel round, right? But it's beneficial, right? I can take the extra cash. Or you could have a stage where you could have a situation where, depending on the industry, depending on the market, some people just kind of need more capital than others, right? If you think about, there is some flavors of EdTech where there is kind of the whole idea of kind of digitizing content, right? That stuff is expensive, right? If you're in kind of an industry where there's, any sort of kind of hardware and whatnot, even if you're just planning for like a small pilot, that's a bit more expensive than kind of, putting an app together where you just need kind of a team of software engineers, right? So in summary, I think, one, I think it's we probably should be kind of relooking some of these terms. I mean, for me now, actually, the way I look at it is that, there's kind of, the first round of funding, angel, pre-seed, whatnot. Then there is kind of the seed stage, and that includes pre-seed and seed extension. And then there's the A, right? I think even today, people, when they say it's A, it's really an A, and it falls within what we traditionally know. So there's a fluidity kind of in the terminology. I think if you have a startup that is able to raise an extra ticket, they're taking advantage of that. It's not, I mean, everybody, it's not a bad thing, so to speak. And then thirdly, it's just really around the context, the industry that they're in, what they're trying to build, how expensive it is to build in an early stage.
Yeah, absolutely. And I agree with that completely. It's very contextual, and you're right that these terms have become quite fluid. It could be anything. Yeah, thanks for that. Let's go to the next one. Unless, Zachariah, you wanted to add something to that. Do you have any thoughts on this increased ticket size?
Yeah, I mean, I think people love to talk about headlines and like people raising $30, $40, $50 million Series A rounds and $10 million, $15 million seed rounds. I think at a starting point, you need to really say, at a basic level, what is the capital used for? So first of all, raising debt capital and equity capital cannot be put together. Like, that's an absolute no-go, right? It doesn't make any sense from a use of proceeds perspective. So if you talk about, did you mention 70 million round that float rate?
17.
Yeah, so of that 17, I think 10 was debt, right? Or 12 was debt. Now, raising debt capital should not even be a headline in from a VC standpoint, because you're raising debt to finance an asset. So if I'm buying a massive warehouse, or if I'm buying a whole bunch of trucks, that really is not part of my seed round. It should be a separate financing altogether. So I think, but obviously founders love to inflate stories, to get. So I mean, it actually really pisses me off when people do that, and people should stop doing that. You can't say that I'm raising $100 million round and 90 million of it is debt, on which you're paying very, very expensive, high interest rate capital, right? So that's a fundamental thing I would say is really separate your equity from your debt, because debt investors don't own they're just borrowing capital, right? In fact, the more debt you take on, the worse it is for your equity holders, because I mean everyone here understands that thing. Secondly, different industries require different amounts of capital. So for example, if you're a fintech, if you're a digital bank, even at the pre-seed stage, if you don't raise at least, $2 or $2.5 million, you can't get a license. If a credit providing license, an FSP license, an EMI, an electronic money license, a microfinance license. So certain industries that are very regulated require a huge amount of tier one capital just to function. right? But if you're an e-commerce company, for example, or your company that's providing, services that don't, like a marketplace where you don't require regulation, it doesn't mean that, a marketplace raising $1 million seed and a digital bank raising a $6 million seed is because the requirements of capital are different. So what really people need to do is look at it from a sector perspective, a need perspective, and then a type of financing perspective. Then these things get normalized.
Yeah, absolutely. Yeah, I hear you. Thanks for that.
Sure.
Let's go to the next one. So it's said that for early stage especially, fundraising is largely about relationships. So the question is, how would you advise founders to build these relationships early on when they're starting out? Or what approaches would you advise them to take, especially when they're thinking about fundraising? Zachariah, I can start with you.
I'll give you some thoughts. As someone, so I spent most of my career in Africa when I moved here 12 years ago, not being a VC, but I started building companies at incubators and venture building studios. So I'm one of the few VCs today that started off being a venture builder, so working with founders. So our team is probably, closer to founders than any other VCs that play in the space. So the one thing I will say as a founder is stop looking at VCs as ATMs, because it's really, really disrespectful and not valuing of our time. Because remember, VCs also have LPs to report to. I mean, I'm sure everyone here knows how VC funds work. In our particular fund, we have more than 200 investors in our fund that we need to report to and return capital to. So it is easier to raise money from an angel, exponentially easier than to raise money from a VC or from a syndicate of angels. Because when you go to a fund, I mean, people here know how funds work, but I mean, essentially, VC funds, the fund managers in VC funds only get paid in year 6, year 7, or year 8, even if they get paid at all. Because you're going to return all your capital to your LPs, usually an 8% annual hurdle rate over 5 to 7 years. So the majority of VC funds never return capital to the GPs. Therefore, GPs are so risk averse and will only look at opportunities where they clearly see at least a 10x return in 5 years. An angel, on the other hand, may look at an investment and say, hey, if I can make 25%, 50% on this investment, I might do it because it just benefits me, right, or my family. So you got to understand that VCs are extremely risk averse. Now, keeping that in mind, if you as a founder are constantly sending emails to VCs saying, hey, I'm doing this, I'm doing that, will you please look at funding me? It's an immediate turnoff because you're literally thinking like a founder, not as a VC. The best way to get advice, money, or resources from anyone is to think like the other person, right?
Yeah, absolutely.
If you're pitching to a corporate, don't pitch as if you're a founder, pitch as if you were in their shoes. How could me as a founder benefit, this insurance company or this bank or this retailer, not how awesome you are, right? So very few founders put themselves in the shoes of the VC. The majority of founders that have pitched to us, not just in this fund, but my last fund as well, have no idea who we've invested in, what our mandate is, what sectors we back. They have no idea. All they care about is themselves. I'm the best founder because of this. My company does this. My company does that. And I'm like, I'm not interested, right? So it's founders really need to take time to understand what investors look for, why they look for something, and should focus on explaining what they do, why they do, and what the story behind is. if you can maintain a good relationship with a VC or an investor for a period of a few months and keep them posted on your progress, your success, etc., without necessarily asking them for money, trust me, in a few months, the VC will come to you and say, hey, I've been hearing a lot about you. You've been keeping me posted regularly for months. Are you raising money? How can I help? Right? But the majority of founders, all they care about is they need to raise money. And they treat VCs like ATMs. And then they're surprised when they get so many no's.
Yeah, I hear you. Yeah, knowing your audience is critical, and empathy is relevant everywhere. So just knowing how to approach the person that you're going to speak to and understand where they're coming from is critical. Yvonne, you spoke about angel investors, and so I'd love to hear this from your own perspective. And yeah, how do you look at this?
Again, it's very similar. I mean, I think investing in general, I mean, you're making a case for somebody to part with their cash, you know, in return, like I said, for an outsized return. So whether it's an individual angel investor, you know, writing you a 5K check, or, you know, an institutional doing 500, you know, there's some kind of foundational things, right? And a lot of what Zach said is you know, is correct, right? You know, I think being able to understand, you know, what a VC is, how they are structured, you know, what an LP is, what a GP is important. I think to add to that, right, you know, and in general, I believe that there is a lot of literacy, improved literacy in the ecosystem. I mean, a panel like this, right, you know, is helpful, right, you know, in terms of being able to educate founders on the fundraising process, how to go about it, what to do, what not to do. And so today, you know, you really shouldn't have that excuse of just kind of not knowing, right, you know. And then I think that, you know, one of the biggest pieces of advice that I got, right, you know, even though I'd done some of the angel investment before, is just to really understand that, you know, the fundraising process, it is a process and it takes a bit of time, right? You know, it's almost never always, you know, you just have the first conversation with somebody and they say, yes, I would write you a check, right? You know, so when you understand that and know that, okay, I have to plan, you know, 6 months, 9 months, 12 months in advance, of course, depending on the stage that you're in, you know, that relationship building, you know, is important. Then you know to kind of schedule that so that at the point in time where you really need that check to come in, you build the relationships and, you know, it's a smoother process, right? You know, now to your question around, look, how do you build the relationships, right? You know, look, even if you knew nobody, right? You know, let's even say that extreme case. Again, our ecosystem has matured, has really grown, and there's a lot of players, right? You know, even just the simple thing of here's what I'm building on my kind of handles, whether it's Twitter, Instagram, whatnot, you know, trying to get, you know, a Medium article out and whatnot. A lot of those things help, right? You know, because remember, right, you know, with the VCs, I mean, they're not always kind of bad people, right? They actually do want to invest, right? You know, so part of their work, right, is actually doing all the research and looking for these opportunities, right? You know, so again, you are, you know, somebody out there with an idea, a pitch deck, you know, maybe kind of like an MVP. You claim you don't know anybody. You can at least start to say, okay, within the ecosystem, with my social media handles, I can educate people about what's happening. And there's always tons of events, right? You know, pitch competitions that you could participate in. I mean, you know, just really plugging yourself in. And if you do that, you're consistent with it. Like I said, you budget the time because you know that, look, fundraising is a process. Eventually, you will then start to get the inbounds where people are asking for a conversation and asking and probing a little bit more about what you're doing, right? You know, so yeah, so I think just in summary, the two big things is that number one, understand how a VC is structured, right? You know, even an angel investor, understand how they're structured. I mean, this is somebody that hard in cash, whether they got it from an LP or whether it's an angel investor investing their own cash, and you know, understand how they think, the kind of returns they're looking to generate, the time frame, and all that kind of stuff, right? And then understand the process that it takes a little bit of time, and you need to kind of schedule that and factor that.
Oh, absolutely. Yeah, thanks for that, Yvonne. That's like on the nose. We have a few more minutes left, at least for the Q&A, for us to have this conversation. But there's a few questions that I really want us to get in, and so I'm going to sort of bulk them together. But some of the interesting interesting findings in the report is sort of the sector and country focuses that we've seen over the last few years. So in terms of, Nigeria, South Africa, Kenya, and Egypt sort of being the center of most investments. And then also from a sector perspective, we have fintech really taking the cake for investments onto the continent. So my question is, do you see those trends changing? And is there a need for it to change? The real thing we're trying to get at here is, how do we spread this investment across multiple markets and multiple sectors, now that we're seeing that it's sort of condensed in a particular place? I hope that's clear. Yvonne, you could just go ahead and we'll start with you.
Sure. I mean, the simple answer is yes, right? I mean, I think on the continent, there's no shortage of, big problems that have, big solutions and can generate kind of, outsized returns, which is kind of what fits into the definition of VCs, right? And beyond those markets that you talked about, I know that kind of recently, kind of in the last 6 to 9 months with my angel investment group, we've seen kind of, very great ideas coming from, markets that you didn't mention, right? I mean, I think if you look at Francophone Africa, it's very interesting. So eventually, they're going to start to pop up in the charts when, of course, the numbers hit a certain threshold and whatnot, right? So certainly, so I think the answer is yes, right? I think what you're seeing, of course, it's tracking the size of the opportunity. I mean, these are kind of, the big economies on the continent. It's understandable that, the first wave of kind of, funding will come to those markets just from a numbers game, even just the, kind of the volume of, startups and opportunities, are going to be highest in those ones. And then over time, it's going to spread out. And I think the same goes with the, with the sectors. I mean, fintech being number one is probably not just an Africa thing. I mean, we probably see that in, you pick a market, right? And we probably see that where, kind of financial services, is, anything kind of financial services related is usually kind of, top of the list. And that's, again, it's just, it reflects the size of the opportunity, I think is the short answer. But yes, I mean, I think I know that even me, just like in recently, just seeing some very great stuff, and Francophone Africa kind of, stands out for me, Cameroon, Senegal. So I would expect that, in the next kind of version of the report, at least 1 or 2 of those countries would come out.
Yeah, I completely agree. We're seeing sort of similar trends even in our portfolio, with really cool startups coming out of Zambia and Zimbabwe and Ethiopia and Uganda. And so I definitely see that trend shifting. Over to you, Zachariah. I'd love to hear your thoughts on this as well.
Yeah, I mean, specifically around, like everyone's been talking about the big 4: South Africa, Nigeria, Kenya, Egypt. I mean, as Launch Africa, we've made a specific effort to look at not just second tier, but even third tier markets, right? So I can really agree that Francophone Africa has, until about 2 years ago, people didn't even know how to spell most Francophone African countries, right? It's quite shocking. But the 2 largest markets in Francophone Africa are Senegal and Cote d'Ivoire. But the sleeping giant, as I say, in Francophone Africa is the DRC, right? So for those that didn't pay attention during geography class, right? The DRC has almost 100 million people, right? And I mean, I've been to Lagos many times, but I'm not sure people here know here that Kinshasa has more people than Lagos. The people here know that. Kinshasa has about almost 19 million people. I was in Kinshasa just in October last year for a week, and these markets, although not as technologically advanced as Lagos, Nairobi, Cape Town, and Joburg and Cairo. If you think about it, Lagos about 7 years ago had precisely zero relevant tech startups. Bogga, Interswitch, Flutterwave, Paste, most of these prominent fintechs that we see today were only really born in 2012, 2013, 2014. So if you use the same math and say, the DRC has very similar metrics to Nigeria from a population standpoint and a customer purchasing power standpoint. It's just that there's a slight lag. So I'd say the most bullish market from a B2C standpoint would, I see someone say Lagos has over 20 million people. Yeah, it depends, who you count and who you don't count. I think officially Lagos is probably about 16 to 17 million people. Similarly, Kinshasa officially has 19 million people, but unofficial numbers, you add another 20%. Yeah. But so very bullish on Francophone Africa. The key thing I would say is when you enter new markets, you have to look at the most basic problems that people need solving, which is transportation, logistics, food and water security, education, healthcare, right? If you can focus on how technology can make these 4 sectors of industry faster, better, more efficient, and cheaper, you're going to win. It's as simple as that, right? So we've, as a fund, we've now invested in 19 countries across Africa, including some countries like Benin and Togo, that a lot of people would never concentrate on. And the reality is, even if you happen to come from a country like Benin or Togo or Botswana or Madagascar, for example, you still need to eat, to travel, to get educated, and to take care of your health. So anything that uses technology to reduce the time and the effort it takes to reach your end goal will eventually be worth investing in. We recently backed a company in Cameroon called Waspito. It's a telemedicine healthcare startup, and you'd be surprised to know that the cost of seeing a doctor, a GP, in Douala is more than in Cape Town. I live in Cape Town, and Cape Town is a relatively first world city, but it costs more to see a GP in Douala than in Cape Town by almost 30%. And if you can use technology to reduce the cost of that by seeing a doctor online through a telemedicine consultation for avoidable medical issues, and you increase the wages of doctors during their off-peak hours or hours that they're available, then that's a viable business model and it's repeatable. And in situations like this, if you can convert a B2C solution to a B2B2C solution, so you get buy-in from insurance companies and HMOs, health and medical organizations, you can get a significant amount of risk mitigation from a distribution standpoint. So yeah, absolutely. That was a very long response, but yes.
Yeah, thank you for that. I think I'm going to jump us over to the final question of the conversation, just to get a bit more context for founders in their early stage. And the question is, are there any changes in the ecosystem that they should know about for them to position themselves better? And generally, how do you position yourself when you're trying to raise early stage funding? Yvonne, we can kick off with you.
It's a lot of what we've obviously discussed, understanding kind of the outcomes that any investor is looking for, right? So that you make sure that, you kind of fit the bill, understanding that it's a process. So making sure that you kind of budget that, and factor that in so that you're not kind of scrambling, a month or a day before, you're running out of cash, or you really need the cash. I think the third one is, just paying attention at the macro level. Again, when we talk about, look, how is the VC structured? What does an LP mean? What does a GP mean? When you understand all of that, macro conditions, factor in, right? There's a certain set of return that a VC is expecting, of course, because of the risk involved. And so a simple thing like interest rates goes up, and some of that funding is flowing to other kind of instruments, right? So just paying attention, kind of, at the macro trends, right? Because what that then does for you is that, back to the point about it is a process, it takes a bit of time. For you, that might mean, okay, look, I was budgeting 6 months, now it's 9. I was budgeting, I don't know, 1-2% hit rate, maybe it's lower now, and everything from, even just how much I'm looking to raise, right? So I think that's one thing that, it's always important, just pay attention kind of, at the macro level, right? Because all of these things also kind of, factor in.
Absolutely. Zachariah, I'll ask you the same question. What are your top 3 things that you think people should be looking out for here?
I mean, looking out for specifically with investors, or
with regards to positioning themselves when they're trying to raise follow-on funding. So what are the things that they need to do? Top 3.
Follow-on funding. So if you've already gotten some funding.
Sorry, I meant early stage funding, not follow-on.
Yeah, I mean, I thought we already covered this earlier, but yeah, I mean, just focus on. I almost feel like a broken record because we're repeating these things, but your team is very important. You have to have some demonstrable traction, especially in markets like this where there's a lot of competition. In financial services, in retail, in e-commerce, and I mean, Yvonne made a very good point about market turmoil with interest rates and with war, etc. We're unfortunately going to be there are going to be pretty strong headwinds from an investor risk tolerance perspective in the next couple of years, sadly. So you really, as a founder, need to really think about how are you, what is your unique selling proposition that makes you better than other competitors around you. And remember, a competitor isn't, and I say this every time I talk to founders, a competitor is not someone who does the same thing as you. A competitor is someone who solves the same problem that your end users have, right? So founders typically have 5 to 10 times more competitors than they typically imagine. And they dramatically overstate their market positioning. I mean, I joke about this every single time. In that pitch deck, slide 7 or slide 8, you have the one particular company, and then you have 9 random logos with tick boxes and crosses. We do this, we do this, we do this. They don't do this, they don't do this. I'm so sick of seeing those slides because all those metrics are doctored, right? You can choose what metrics you have and deliberately omit things that you don't have and make. I mean, I saw a pitch deck recently where someone compared themselves to Amazon, and they created metrics. They found out one small thing that Amazon does not do, and they listed it, and see, Amazon doesn't do this, but we do it. Therefore we're better than Amazon. I mean, this is an extreme example, but like, honestly, founders need to be honest about what they can do and what they can't do. Trying to be the best, brightest, and smartest person in the room is only going to make you an egotistical person. So, you just have to be honest. And, the other thing I say is, founders, you really, I think more than 80% of founders should not be founders. They should rather work in corporate or work in a business or be a consultant. Being a founder has been glorified so much in the last 4 or 5 years, where it's cool to be a founder and people want to start startups. I mean, I saw a tweet today in Lagos, someone saying, my goal in life is to raise my pre-seed and then get married. because because pre-seed rounds are so large, and then you get married and have kids. It's so think really hard about being a founder, because being a founder means you have to sacrifice at least 5 years of your life. You will likely not have a healthy relationship unless your spouse is also a founder. And it's a lot of, you have to sacrifice pay for equity, and very few people understand that trade-off. You can't have a fancy car, you can't live in a fancy house, you can't be eating in fancy restaurants, you can't be sending your kids to private schools, because you're sacrificing all of that for future payouts when you can do it, right? So I would really think really hard before you even want to start a business, because there is a lot more security and stability and better lifestyle in just working for a large company, or being a consultant, or doing other things, or starting your own business, right? Remember, an SME and a startup are not the same, right? People confuse SMEs. SMEs have only one goal. It is to create value for the founders and to be profitable. Startups are not SMEs. You really, really, really have to remind that every day when people want to start companies. So just being a founder is not for everyone. And I would highly encourage people, because when you pitch to investors, it's very easy for us to know if you're a serious founder or you're doing it just because it's a cool thing to do. Sorry, I've digressed.
Absolutely.
But I really wanted to.
No, you answered the question. Thank you very much. I think we're going to dig in now to our Q&A session. I think we're running super duper over time, but it's fine. Remember to post your questions in the Q&A box and not in the chat. I see a few questions around team, and I think we've covered that fairly deeply in terms of what are we looking for, what's a good team, etc. I see a question here around valuations for pre-seed tech startups. And so maybe we can talk about that a bit. How do you determine your valuation, especially at your very early stage? Maybe Yvonne, you could quickly run us through that.
Well, Zach is probably the good one, because he's on actively investing. But again, in general, I mean, the valuation question is more an art and a science. It's again, because you're talking most of the time pre-product, pre-revenue. Even if there is some revenues, it's very early stage. There is not yet proof that this can be consistently. That revenue can be consistently generated, and of course, there's the idea of how you can scale it, right? So it's more of an art and a science. So I think what I find is that the yardstick is usually around how much you should be selling at any point in time, and then kind of working backwards from that, right? So if it's kind of the first check in. And then the other thing to should mention is that, certainly, especially when you're talking about accelerators and whatnot, they're very fixed in terms of how they value startups, regardless of kind of, industry and whatnot, right? So if you were in a Techstars or YC and whatnot, their term sheet is pretty standard and, to the best of my knowledge, non-negotiable. So that's one bucket, to talk about. But in general, I mean, I think the yardstick in the early stage is really just say, okay, look, how much should you be selling at that point in time, and then kind of working backwards. And that's one framework, because like I said, it's more of an art than a science.
Yeah, absolutely. Zach, maybe how I can sort of add in an additional question that's already been asked is, what's the ideal amount to give early stage, or is there like a cap on what's good and what's not when you're doing your first round?
In terms of how much I mean, there are industry averages, and again, the problem with averages is they are averages. But at your pre-seed, you really shouldn't be giving up anything more than 10 to 15% in equity. First of all, you should not be doing price rounds until your Series A. That's a starting point. You should be raising any money. First of all, only raise when you absolutely need to raise. As much as possible, you need to use your own capital. bootstrap yourself to get to where you are, and that includes friends and family, right? If you haven't bootstrapped your own capital, friends and family, it's very unlikely that someone's going to be keen to. I mean, if you're not willing to invest in your business when it's at the most risky stage of its life cycle, which is pre-seed, pre-product, pre-revenue, why is someone else going to give you money? It's as simple as that, right? So the starting point is you really need to exhaust all your resources. I see way too many founders that are raising capital for a product, but they work at Access Bank, or they work at GT, or they work at MTN, and this is a side hustle. I can tell you, you're not getting a single naira from me, or a single dollar, not a single, because you have a side hustle, you're very comfortable, and you're doing something as a side hustle. It's just never going to work, right? So that's an absolute non-starter, right? So if you decide to go down the founder route, you have to have saved up enough money from your corporate career to put into your own startup. So ideally, the first 1 year of your startup should be entirely self-funded amongst the co-founders. And the justification for that is you own 100% of the company, right? So all the upside is yours before you raise a single dollar of funding, right? So that's the first thing I would say. So after you have exhausted all of your personal resources because you believe so much in an idea and a product, right? It's still going to be very hard to raise funding to build a product. You have to have a prototype, a working prototype, and then you can maybe raise some pre-seed funding to take a prototype from prototype to commercialization. That's when you can get some pre-seed funding. But even at that, the pre-seed funders are going to ask you, prove to me that you spent your own money and time building a prototype. And if you don't have an answer for that, you're going to get, you're going to shoot yourself in the foot. You should really, really minimize how much you raise. I can't say that enough. And if you have to raise, nothing more than 10 to 15% equity. And when you raise, always create an ESOP, an employee stock option plan, early enough. Because the earlier you create a plan, the more you're able to account for dilution. If you wait until your seed, Series A, and seed extension rounds, etc., you'll be forced to create ESOPs when your valuation is very high. My ideal preference, the moment you found a company, if you're two founders that own 50% of the company each, on day one, set aside 20% as an ESOP, 20% for future employees. So both of you as founders go to 40% each, as if you have two co-founders, and that 20% will then dilute over the next 4 or 5 rounds. If you don't have an ESOP, you're going to wait until Series A, and at Series A, when your valuation is $40 million, your Series A investors will say, I'm sorry, where's your ESOP? And you're going to say, I don't have an ESOP. Well, go fucking create an ESOP. And then you have to carve out 20% or 10% of 40 million, just $4 million out of your own pocket for an ESOP. Whereas on day one, you're carving out $0 for an ESOP because you haven't started. So you got to be real smart about how you set up a company and how you incentivize people.
Absolutely.
As far as how much you raise, it varies. I mean, 10 to 15% at the early rounds and 20 to 25% at most in future rounds, Series A.
Just as a quick follow-up in a sentence, there's a question here that says, investors are looking for traction to invest when some of us need money to build traction. So in just one sentence, how do you respond to that?
You don't need money to build traction. You need to use your own capital to start building traction. Once you can show some traction and you can prove that you have the ability to grow month on month with your own sweat equity, then an investor will gladly fund future growth. You know, even great startups like Kuda Bank, etc., They couldn't raise the first dollar of capital until they could show, a 10,000 user wait list that they built by their own money. And then, yes, you can raise capital, but you can't expect to start from 0 customers and ask people for money to get you the first customers. No one's going to do that. No smart investor will give you money. I won't, at least.
Yvonne, your thoughts really quickly.
Yeah, good question. My short answer to that is, traction does not always equal kind of a revenue related metric. I think that's what people are usually worried about, that, investors want to see actual kind of revenues coming out, right? Especially because we use terms like pre-revenue, right? And so it's always stuck in people's heads, right? So traction is really just, it's a metric. It's an important metric. It's not a vanity metric. It doesn't always have to be revenue related, but it's one that is kind of growing in the right direction, right?
Yeah.
And so when you think about it that way, it's not always the case of, oh, look, I have to spend money because I have to get the client to start to pay and whatnot, right? It's a metric that is relevant, and then it's growing in the right direction.
Great, thank you for that. We have just a few more minutes, so I'm going to pick a question, our last question. Unfortunately, we can't get through all of them, but please feel free to connect to us here on LinkedIn, and we find us and we will chat. So there are currently a lot of conversations around the downturn in the market. Could you please elaborate in layman's terms what it means for investors and startups in different stages? So I will take this as our last question, and maybe we can start with you, Yvonne.
Short answer, again, it's like what I talked about. If you kind of pay attention to kind of macro and whatnot, and we wouldn't get into kind of technicalities of, interest rates going up and inflation and whatnot. Practically what that means for you, remember, like I said, it's a process. So if you were budgeting maybe kind of 6 months, it's a bit longer. If you were, ideally looking for like a $500,000 check, it might be shorter. The valuation terms, might be, stricter. You might be talking to more people. So practically for you, that's what that means. And so it's a question of just kind of, updating your expectations, right? Because things might be longer. You might not get as much, right? That you're looking for.
Okay. Anything from you, Zach?
No, I'm good.
Okay, great. So we'll call it here in terms of questions. There's so many more, and I'm sorry we can't get through all of them without spending 16 days on this call. So we have to call it at some point. But before we close out, I'd love to introduce Bolu from Tekabal. I believe she has some closing remarks, and then we'll just run through the end of the session and allow you guys to get back to your day. So Bolu, please go ahead. Sorry, you're muted. You're muted. We can't hear you. Yeah, there you go.
Yeah, okay. Yes, thank you so much. I'd just like to keep this really short so I don't delay everyone. So thank you very much for putting this together. I think first of all, I'd just like to thank our partners, Future Africa and the Baobab Network, for their work on the reports and the events. I think it's been very well put together. Obviously a lot of hard work has gone into it, and I'm glad that we had a chance today to just speak through that, take people's questions and comments, and just talk about, because I think it's a really important topic, for the African startup ecosystem. I know people think there's a lot of money coming in, but not a lot of that is going to early stage startups. So it's important that we talk about these things, how we can improve the current state of the industry and all of that. And I think it's important, if you've not gone through the report, if you just breeze through it, I think it's important to just take some time after this to just, read through and see some of the stuff that we're talking about as well. We've offered recommendations for startups and investors, so it's not a one-sided report. We're looking at all the stakeholders involved. So yeah, definitely read through it. If you have thoughts about it, you can share those. So yeah, thank you very much. I think this is very insightful. Thank you, Namara. And thank you to our panelists as well. Very wonderful conversation.
Absolutely. So I'm going to give, thank you, Bolu. I'm happy to have you join us briefly. Yvonne, 1 minute as closing remarks, and then I'm happy to let you get back to your day.
No, thank you for having me. I think, I'm just trying to think. I think it's very important. It's very insightful that you guys really focus on kind of the early stage, phase of a startup. So that's very important. And I think final words as a founder is just always kind of researching and understanding like who you're speaking to at the end of the table. how they incentivize their expectations and whatnot. That really goes a long way in understanding, how to, package yourself and couch the conversation.
Thank you, Yvonne. Zach?
Sorry, I lost that. Sorry, I was just attending to my daughter for one quick second. Sorry, say that again.
No worries. No worries. I was just asking for your final remarks, just 1 minute before we close out the call.
Yeah, no, I think for all the founders here, I absolutely love working with founders. They're the reason why I go to work every morning. Is just be really brutally honest with the way you engage with investors. Look at investors as human beings and not as ATMs, because that is something that a lot of founders end up doing. Everyone has metrics and mandates and strategies, so just respect that. Do your homework on what investors want, and keep people posted. Communication is key. As founders, founders need to communicate with investors, advisors, partners, just as much as we as investors need to communicate with our LPs. So communication is key. Yeah, those are the two things I would say.